institutions own the majority of our real estate. You know, we can talk about the sponsors, but you know, if you've got an 80% loan, you've had a 25% decrease in value because your rents have gone down, your cap rates have gone up. You know, the institutions own most of the real estate. But what we're seeing in the cycle today, because there's no forcing mechanism, is what we either call pretend and extend or pray and delay. They're just kicking the can down the road, and they're not really foreclosing or realizing these losses, because the big strong banks don't have to realize the losses, because you know they don't want to have that bad real estate. Small banks can, because they don't want to impair their balance sheets. So I think that, you know, there really hasn't been a forcing mechanism to really realize these losses that are on paper. Eventually, when we start, the assets start flowing and, you know, start seeing foreclosures, we'll see a different real estate market, but there's going to be huge opportunity. So now that there isn't that much flow of assets because the institutions aren't selling, and most people aren't selling because of their seller or liquidator, but there is capital coming back to the marketplace. Where are you guys seeing the opportunities?
I think Gary hit it in the head, really, which is, I think a couple of years ago we all sat down and figured that values have dropped 30 to 50%, and if you borrowed 75 to 80%, there was going to be this $1 trillion tsunami of foreclosures that would happen, and we'd have a tremendous opportunity to buy all these great deals, and it really hasn't happened. And as Gary mentioned, the lenders are extending. I think it's people with floating rate loans and low interest rates that are squeaking by. And I think also it's just the time it takes to foreclose on a property. That can take a year to 2 years. And so you've got a number of factors that are really delaying the tsunami. And I think more people think it's going to be the slow motion train wreck that will occur over a 3 or 4 year period. But where we're finding opportunities is really a combination of things. It's either the, you know, the special servicer, the lender that wants to sell a note. We're going direct to special servicers and lenders and making unsolicited offers. And the beauty about an apartment is you can quickly value it and figure out what it's worth and apply a discount to the loan. So we're looking there, but I think, again, the challenge is a lot of lenders want retail value for their note. Second, you're getting foreclosures, not so many in coastal markets, I think as Gary mentioned, but the Phoenix, Las Vegas, Inland Empire, Florida, a lot of the Sun Belt markets where they were heavily single-family construction job-oriented markets, you're starting to see more foreclosures there. I think third, it's really the institutional capital that wants to exit a market or repatriate their capital. So a combination of three sources, but so far it's very early in the process. Maybe it's inning 1 or 2. We expect not a lot of activity in 2010, but 2011, 12, and 13, a significant flow of foreclosures, discounted payoffs, and other bankruptcies that will occur.
But Jerry, you still have 12 acquisition guys in the market every day calling on people. Like, they're always calling me, asking me how to structure it. Okay.
Sure.
I mean, you're in the marketplace. I mean, you're seeing opportunities, but I guess the ones that are the really good ones are getting bid down too far, and the rest of them are too risky. Or what is it that you're seeing? Because I know you're seeing a lot of flow.
Sure, I think we're seeing some flow. I wouldn't say a lot of flow, and I think the flow we are seeing is the Class C asset in a tough location in Texas. It is a small property out in Inland Empire. It's tertiary markets, tertiary locations, Central Valley. It's not the Class A location, you know, Westwood, Class A apartment. So we expect those to hit eventually, but right now it's a lot of Class C and D assets that are going to take a lot of work, and they're very challenged properties.
Where are you seeing the opportunities, Jay?